Hi everyone. Now in the part 4 of the equity valuation, we will try to analyze some more concepts. The first concept is how to estimate the intrinsic value of a company. So this is basically a valuation game. Now let us see what are the techniques of equity valuation. See the number of techniques of equity valuations are there. One is balance sheet technique. In balance sheet technique, we have book value technique, liquidation value, and replacement cost analysis, which will be done. And secondly, we have got discounted cash flow model. See, discounted cash flow model has got dividend discount model and free cash flow model. And finally, relative valuation technique. In this technique, we use the P by E ratios, price to book ratios, and price to sales ratio. Before we start this analysis, I would like to tell that there are a number of mathematical concepts here. One should be aware of what is time value of money, how to calculate the present value, how to calculate the future value, what are the formulas used for calculating the present value and future value. If you want to know about all these concepts and detailed analysis of this concept, I have made a separate video on time value of money. So time value of money means what will be the present value of the money, what will be the future value of the money. These are all the time value of money concept. So here in dividend discount model and the free cash flow model, these concepts of time value is extensively used. So some of the formulas may find a little bit intimidating for you. So bear with me and you go back to that. I will put a link in the description. You can go back to that video and have a look at it, and then the concepts will become much more clearer. Okay. Now, coming to the first method, that is the valuation game. In this, what is intrinsic value? We should know. See, intrinsic value of a company is obtained by carrying out an analysis of its cash flow and the operational expenses of the firm. See, we should understand that valuation is a dynamic thing. Hence, valuation is always carried out at any particular point of time, like quarterly, half yearly, yearly, or at any point of time you want to analyze a company for its suitability for any stock purchase. At that particular point of time, we carry out valuation. See, valuation is always considered as an educated estimate. Any amount of data you can feed into the calculation of the valuation of a company, there will be lot of variables involved in that. So hence we should understand that it is always an educated estimate. Valuation is both a science as well as an art. Okay, it requires knowledge, experience, and professional judgment also. Suppose if the intrinsic value of a particular stock or a company is greater than its market value, then the company is underpriced and it is a buy. However, if the intrinsic value is less than the market value, the company is overpriced, and usually analysts advise to avoid such stocks because the intrinsic value is already less than the market value. Now coming to the first method, we have seen the chart. No? In that chart, we see first one is balance sheet valuation. So in balance sheet valuation, the first method is book value. Okay. Now book value consists basically of two components. Okay. Net worth of a company, we have discussed extensively in part 1 and part 2 what is the net worth of a company. Net worth is nothing but the paid up equity capital plus reserves and surpluses. Okay. Now the number of equity shares outstanding is also a part of the book value. Now what is book value? It is nothing but the net worth divided by the equity shares outstanding. This will give you book value per share. Okay. So this particular formula will give you book value per share. Now method 2 consists of liquidation value. See, liquidation value have two components, sale of the assets minus the money to be paid to creditors and preference shareholders. Simple concept. Whatever the assets available at any point of time, you sell all those assets, and whatever money you get, you utilize that money to all the creditors and preference shareholders. And there is another point we have to understand is the number of equity shares outstanding. So after you sell the asset, less the money paid to creditors and preference shareholders, whatever is left out when divided by the outstanding equity shares will give you the liquidation value of a company. See, liquidation actually does not reflect earnings. We should understand, when we are trying to purchase a stock, we are not trying to purchase a stock which is already at this liquidation stage. Okay, so our effort should be more on analyzing and understanding the earnings estimates for the future of the company for the next 1 year, 2 years or 5 years. So based on that, we should purchase a company lot on the liquidation value. See, even though all these concepts have been discussed, some of the concepts are flawed, because this liquidation value may be useful for whenever distress sale and all, whenever you are going for hedge funds and all, they may be able to try use this liquidation value, because they buy companies which are under distress. So in such cases, this liquidation value analysis may come useful. Okay. See, next, coming to the third point is the replacement cost. It is the replacement cost of assets and liabilities. Okay. Now, this is based on the concept that the market value of a firm cannot deviate too much from its replacement cost. So we have to understand this. So the market value of a firm cannot deviate too much from its replacement cost. The ratio of the market price to the replacement cost is called as the Tobin-Q ratio. Again, coming to the advantages and disadvantages, see, even though this ratio considers market price and the replacement cost, that is whatever the assets are all which are available, so what will be the present value of those assets as of now? So that is called as the replacement cost. However, it does not consider organizational capital like employees, efficient management, the productivity of the employees. These are all intangibles which are never taken into consideration while carrying out a replacement cost. This is one of the disadvantages of the replacement cost method of valuation. So if you have to consider a going entity, so then balance sheet analysis may not be a very good method. So we have understood three balance sheet valuation method. One is the book value, second is the liquidation value, and third is the replacement cost or the replacement value. So all these are balance sheet taken out from the balance sheet directly and then calculated. Okay. Hence, it will not be for a going entity. That's what I'm saying. These concepts may be good for those companies or those organization which would like to assess a company based on the balance sheet, not for the purchase of a company which they want to invest for next 5 years or 10 years. Okay. Now, dividend discount model. This is the second concept. Let us understand what are the assumptions involved in carrying out this dividend discount model analysis. So we see, in carrying out any mathematical analysis, it is always very important to understand that there will always be assumptions. So without assumption, you cannot do any mathematical analysis. Dividend discount model is basically a mathematical analysis. So here the first assumption is dividends are paid every year by a company. So it is assuming that a company will pay dividend every year. And secondly, the first dividend is paid only after 1 year from the date of purchase. So suppose you purchase a stock at any point of time, you will get the dividend only after 1 year, even though that may not be happening practically in the stock market, but it is an assumption which is being made now. Forecast value of share price and dividend after 1 year is known. See, we will explain at the end of this presentation how are we going to carry out the forecast value of the share price and the dividend forecast value of the dividend after 1 year. So it is saying it is already known. How? It means if you have to analyze any company through dividend discount model, you should assume that there is a dividend rate, growth rate of the dividend, or what is the dividend which is being paid. This is always analyzed and assumed through the historical dividend paid by the company. Okay. Similarly, historical share price is taken into consideration, and based on that, the dividend and share price forecast is done. Now the dividend per share grows at a constant rate. That's what I'm saying, and every year. So the first assumption is this assumption which is made, that the dividend is going to grow at a constant rate, is for the constant growth model. The second concept is the dividend per share grows at an extraordinary rate for a finite period. Let us say the dividend will grow at an extraordinary pace for first 5 years or 7 years, and thereafter it will grow at a constant rate. See, extraordinary rate means it may be an exponential rate. So you should know what is an exponential. Exponential means 1 year it may be first year dividend may be 5%, second year may be 10%, third year may be 15%, 18%, 25%. It is exponential, so it keeps on increasing. At a constant rate means it is constant every year. Like suppose if I say the dividend is going to grow 5% every year, it means irrespective of anything, the dividend will be given only 5% addition every year. So that is known as the constant growth rate, and another is extraordinary growth rate. Now the dividend per share growing at a constant rate above normal rate experience decline rate of growth for a while, and thereafter constant growth. This is used for the H model. We will discuss all this. See, what they say is the dividend per share growing at a constant rate above normal rate experiences declining rate of growth for a while, and thereafter a constant growth rate. So you can only analyze this as a double hump. Initially it will be extraordinary. So after a period of time there will be a decline, and then it becomes a normal or a constant growth rate. Now how are we going to calculation method? See, the valuation of the equity share through this dividend discount model is equal to the present value of expected dividends from its ownership. Now it is the present value of the dividends from its ownership. So this concept, again I will tell you how are you going to calculate the present value. So let us assume that a company is giving dividend every year as per this assumption. So today if we assume that the dividends are going to grow at the constant rate of 5% every year. Okay, so what will be suppose if the company is giving a dividend of 100 rupees. See, for the sake of calculation we will analyze 100 rupees. Okay, so after 1 year, if the dividend is going to grow at 5%, so you are going to get 105 rupees. So that is the future value after 1 year. Now, what is going to be the value of 105 rupees today? So that is 105 is after 1 year. So what will be its value today? So you have to discount it by the discount rate. What is the discount rate? Discount rate can be the present inflation rate, or there are many methods of analyzing the discount rate. So the discount rate will be different from the growth rate of the dividend. So you are going to discount it from the suppose if the discount rate is 6%, let us say, it means like the present rate of interest of the bank is 6%. We usually that is the present analysis which is being done. Usually we understand the discount rate will be the bank rate at any point of time. So today the bank rate is 7%, and if the growth of the dividend is 5%, so you are going to divide that 105 by 1 minus R. So what is 1 minus R? The R will be your rate of return which you expect. Okay, so That is what the present value means. So that is the present value. Future, after 1 year, a company giving a dividend of 100 rupees at an increment growth of 5%, you will get a dividend of 105. But if you discount that with the rate of return expected, then you will get the present value. So the present value of the share price expected when the equity share is sold is the second concept which is going to be used. Now let us analyze the single period valuation method. So what is single period valuation method? In this method, we will consider that any person holding a share today will sell exactly after 1 year. So that is single period, means 1 year period. Okay. Now the present value of the share after 1 year will be the future value of the share, that is P1, divided by 1 plus the rate of return expected. So 1 plus rate of return expected, if you divide it by P1 is divided by 1 plus R, you are going to get the present value of the equity share, where P1 is the value of the share 1 year hence and R is the rate of return or rate of interest. Okay, this will just this will be much more easier. Now present value of dividend after 1 year will be same concept. Whatever formula which we are going to use for the stock, we are going to use for the dividend also. So if the D1 is the dividend given after 1 year, so if you divide the dividend by the rate of return 1 plus R, you are going to get the present value of the dividend. So D1 is the value of dividend 1 year hence and R is the rate of interest. So if you combine both these, that is going to be the present value of the stock, that is D1 divided by 1 plus R plus P1 divided by 1 plus R. So the expected rate of return. Now coming to the concept of expected rate of return, that is expected return is this R. So inversely we can get the value of this expected rate of return if we know the dividend and if we know the future value of the share. So given the dividend expected and the rate at which the dividend grows, that is G is the growth of the dividend, and current market price P0 of the share, then expected rate of return, this one can be calculated using the formula D1 divided by the present value of the share plus the growth rate of the dividend. Now let us come to the multi-period valuation model. In multi-period valuation model, one important assumption is made is, see, equity shares have no expiry period. See, any equity share issued by a company is perpetual. Okay, it will exist till the time the company shuts down. So there is no expiry period for the equity share. So what should we assume in such cases? Hence, in such cases, we assume that the company will give infinite dividends. It will keep on giving dividends every year. So the present value of the equity price will be, first we have to calculate the present value of the dividends. So if we take T as the first year, and if since the company is going to give you the dividends infinitely, so T, this is the summation. This symbol is summation. Summation of T is equal to 1 up to infinity is dt. So if I say T is equal to 1, D1 means the first after 1 year you will get a dividend D1 divided by 1 plus R to the power of 1. So this will be the first year dividend. Present value of the first year dividend. Again you will add this D1 will become 2. So D2 divided by 1 plus R to the power of 2. R square ho jayega. It will become R1 plus R square. So it will keep on going like that. D3 divided by 1 plus R to the power of 3. D4 divided by 1 plus R to the power of 4. And D100 divided by 1 plus R to the power of 100. It means 100th dividend you are going to receive is going to be divided by 1 plus the rate of return to the power of 100. So, but if we want to consider valuation of equity for a finite period, say N, see this is the equity price. Since in multi-period valuation model, we are considering the company is going to give infinite dividends. Hence, the equity price will be just equal to the present value of all the dividends. This is the present value of all the dividends that is going to be received infinitely. That is going to be the equity price. However, if we consider that the valuation will be for a finite period, let us say instead of infinity, we will say it will be for a 10-year or 20-year period. In such a case, what should we do? So the same formula will be applicable for finite period also. That we will see how it can be analyzed. See, we know, I'll just put out all the equations so that it will be easier for us to understand. Now here you can see that the present value of the equity share, if we consider a finite period valuation model, will be t is equal to 1 to n dt of divided by 1 plus r to the power of t. That is, from first period to nth period, it will be the present value of the dividend. After nth period, you are going to sell that share. So when you sell the share, you will get some value for that share after the nth period. So that value of the share after nth period will be Pn. The present value of that will be 1 divided by 1 plus r to the power of n. Isn't it? Just the way we found out the present value of the dividend by dividing it by 1 plus r to the power of t, here also when we sell the share on the nth day, nth year, so you will get Pn as the value of the share. You divide it by 1 plus r to the power of n. That n can be 10 years, 5 years, as I have just explained. Now coming then, what is this Pn? See, in that case, the Pn will be this Pn I am talking about. The present value of the equity share. What should it be? If we consider after nth period, the present value of the shares should be from n plus 1, whatever dividend we are going to receive till infinity will be the present value of that equity share. Because after nth period, from n plus 1 period, the dividends are going to be issued to the other shareholders, right? So that dividends are going to be for eternity till infinity. So if we consider that as the basis, then from n plus 1 onwards, dn plus 1 divided by 1 plus r, dn plus 2 divided by 1 plus r square, and so on and so forth. This is dn divided by 1 plus r to the power of cube, and so on and so forth up till d infinity divided by 1 plus r to the power of infinity minus n. Why infinity minus n? Because nth period we have already considered here. So if we combine these two equations, equation 1 and equation 2, we get present value of the dividends for a finite period. T is equal to 1 to n dt divided by 1 plus r to the power of t plus this present value Pn. I am going to put this entire value here. Okay, divided by this 1 plus r to the power of n here I am putting. See, don't get confused with r and r, because while typing on the PowerPoint, sometimes you get small r or big R. So don't get confused by that. My bad. So this is small r only. Don't get confused by that. So by simplifying the above equation by mathematical methods, we get the present value of the stock price equal to P0 equal to T is equal to 1 to infinity dt divided by 1 plus r to the power of t only. This is nothing but the previous multi-period valuation model when we considered, where the stock gives infinite dividends. This is the same formula. That's why whether you use single period valuation, multi-period valuation model for infinity or for a finite period, say n, the formula for calculating the present value of the equity share will remain the same. Now coming to the zero growth model. Say zero growth model assumes that the dividend is constant throughout. It means the company will not change its dividend. If the company is giving a dividend of 100 rupees, that 100 rupees will remain same after 10 years also. So in that case, the present value of the stock will be equal to P0, divided by 1 plus r plus d divided by 1 plus r square plus and so on and so forth up to r infinity. See, when the denominator keeps on increasing, like the cube 4 and all, so the value of the dividend keep diminishing. So the present value finally you will get p0 is equal to d divided by r. So this will be the present value of the equity share if we consider a zero growth model where the dividend does not grow at any rate. It will be a constant dividend. Now coming to the constant growth model. So the previous one was dividend is zero growth. There is no growth in dividend. Dividend is going to be remain same for next 10 years. Suppose if you are considering to evaluate a company for the next 10 years, you are going to get a dividend of 100 rupees every year. Now it is a different model. Here the dividend is going to grow at a constant rate. How? This is also called as the Gordon model, and it is supposed to be the most popular model. See, what I will do is I will put down all the equations, so it will be easier for us to do the calculation. Okay, fine. Now here the present value of the equity share P0 will be equal to D1. Now D1 is coming here. The dividend D1 is nothing but the dividend for the first year, divided by 1 plus r to the power of 1. But after the first year, the dividend is going to grow at a constant rate of g, where g is the growth rate. Suppose if I consider g as 5%, so this become 1 plus 0.05. So any dividend which you are going to get will be multiplied by 1.05. So the first year you get 100 rupees dividend, and the second year you get d1 plus 1.05. So d1 plus 1.05, d1 will become 105 here. In the next one, it is d1 plus 1 plus g to the power of whole square. It means it becomes 1.05 whole square into d1 divided by 1 plus rc. So if you keep on going to infinity, you get the present value of the equity share equal to d1, that is the dividend for the first year, divided by the rate of return minus the growth rate. See, this simplification what we are seeing, that this equation keeps on going till infinity, and then we will come and say P0 is equal to D1 divided by R minus G, is based on the geometric progression formula. If you go back and study through the net how the geometric progression formula works, you will get the same answer. So D1 plus divided by 1 plus R to the power of 1 plus D1 into 1 plus G divided by 1 plus R square. So if it goes to infinity, it will be equal to D1 divided by R minus G, where R is the rate of return expected minus the growth rate of the dividend. So this simplification we have to understand is done based on the geometric progression formula. Now coming to the two-stage model. This is first one is the zero growth. Now the dividends have grown constantly. Now it is a combination. It is two-stage growth model. Here two-stage growth model assumes a period of extraordinary growth. So this growth can be good also, this growth can be bad also, followed by a constant growth perpetually. Perpetually means eternally. So equity shares will give dividends eternally. That is the assumption we have made. So we have to stand with that assumption and then go on and calculate the formulas. Suppose if we understand G1 as the extraordinary growth applicable for n period. N period may be 5 years, n period may be 10 years, whatever you take. And G2 is the constant growth of dividend. This is the constant growth formula. Okay. So we will be putting two formulas now, the constant growth and the extraordinary growth. Then you get the present value of the equity share as the formula D1 divided by 1 plus R to the power of 1 plus D1 divided by, see it is growing at a constant, G1 is growing at a constant, this formula. See here this formula is put in here, alright. So you have to understand that, and so on till the nth period. It will come up till here this G1 D1 into 1 plus G1 to the power of n minus 1 divided by 1 plus R to the, this n period may be 5 years. If this will be 5 years, so 1 plus G1 to the power of n minus 1 becomes 4. Okay. So for n periods, you are going to calculate the dividend plus after nth period, the value of the equity share on the nth period. That is, suppose if I say n period is 10 years we have taken, on the 10th year, the equity share must have also changed value. Okay, so that is Pn is the equity share value after 10 years divided by 1 plus the rate of return to the power of n. Now this component will be analyzed again. This will remain the same. Now after n years, the growth remain constant. Hence Pn will be equal to dn plus 1 after the n plus 1. Till nth year there will be an extraordinary growth, but after n plus 1 year the growth will be constant. So so we will go back to the constant growth formula. What is that? D divided by r minus g. Here it is d n plus 1 divided by r minus g2, because we have assumed after nth period the growth will be growth rate will be equal to g2, not g1. So it is r minus g2. Okay, so here also what we will do is we will put out all the formulas, so it will be easy. Okay, now so the extraordinary growth in the first part which we calculated is nothing but the present value of growing annuity. Understood? See, because that is how we calculated in the constant growth model, that any dividend which grows perpetually will be a present value of the growing annuity formula. What is that formula? It is d1 into 1 minus 1 plus the growth rate divided by 1 plus r whole to the power of n divided by r minus g1. Why r minus g1? Because g1 is the growth rate till the nth period. So for till the nth period, we are going to use this formula, that is d1 into 1 minus 1 plus g1 divided by 1 plus r1 whole to the power of n whole divided by r minus the growth rate. So by combining all the above formulas, if we combine all of them, we get this formula that the present value is equal to d1, this d1 into 1 minus 1 plus g1 divided by 1 plus r to whole to the power of n divided by r minus g1 plus you will get, this will get deducted into this. How? d1 plus 1 plus g1 n minus 1 into 1 plus g2. The growth rate becomes of the, see, the growth rate of the dividend has become g1 and g2 here, divided by r minus g2 into 1 divided by 1 plus r to the power of n. So see, you have to understand that these are all deductions which has been made through various mathematical formulas. Okay, if you want to go deep into this, you have to go and solve yourself all these formulas, but for the purpose of doing the mathematics, see, you need the final equation. All your calculation or the valuation of a company will be done based on the final formula which I have described to you till now. So if they say zero growth, what are you going to do? It is going to be d by growth rate, that is d by r. So if they say constant growth, all we are going to say is d1 divided by r minus g. Okay, and if they say two-stage model, you should know that formula for the two-stage model is, that is, first stage is going to be the extraordinary growth g1, second is going to be the constant growth. So for that the formula is going to be d1 into 1 plus g1 divided by this formula. Okay, we'll go back. This one, d1 into 1 minus 1 plus g1 divided by 1 plus r whole to the power of n divided by r minus g1. See, these are all the same formulas, d divided by r minus g. They are only using these for the growth as well as for the to deduct the rate of return and add the growth for n periods, and divided by r minus g1 will be the constant growth model, the denominator of the constant growth model. This is nothing but the dividend received for till the period n here. Okay, now next comes the free cash flow model. In free cash flow model, what we do is, this method of valuation is carried out based on three necessary inputs. One is the estimated future cash flow, timings of the cash flow, and expected rate of return of the investors. See, calculation of the free cash flow involves following procedure. See, the future is divided into two parts. Explicit period during which the firm will evolve and establish. There is some period during which the firm takes time to evolve and establish. And the second is balance period during which return on invested capital, growth rate and cost of capital stabilize. So what will happen? Return on the invested capital will stabilize, growth rate will also stabilize, and cost of capital will also stabilize. See, I would like to again emphasize that even in cash flow model, you are going to use the dividend discount model. Formulas will again come here. So you have to be careful with that. Now coming to the forecast of the cash flow by year during the explicit period. So how are you going to calculate the forecast? So what is free cash flow model? See, this is free cash flow model. We have to calculate free cash flow to the firm. So if you go to part 2 of my lecture, I have explained how free cash flow is calculated using balance sheet method, how free cash flow is calculated using the profit and loss method, how a typical cash flow statement is made. All these I have explained in detail in my part 2 and part 3. I will put a link in the description. You can go and study those chapters there. See, now free cash flow to firm is nothing but earnings before interest and tax, that is EBIT. So you first take earnings before interest and tax, and then deduct tax, and you add depreciation charges, because depreciation is basically a non-cash expenditure. Okay, depreciation is basically on the assets, various capital assets, plus non-cash charges. Whatever non-cash charges which you have deducted, that will be added back, and then deduct, that is increase or decrease in working capital expenditure, less net investment in fixed assets. Whatever reinvestment in as fixed asset you make, that will be deducted from the earnings before interest and tax to get the free cash flow to firm. So free cash flow to firm can also be net operating profit, that is NOPAT, minus the net investment made. See, NOPAT and net investment is and free cash flow to firm, I have explained in my previous lecture, part 2 and part 3. You can find all these details there. So free cash flow to firm is the net cash flow available for distribution to equity and debt holders. Now calculate, see, there are various steps. So first you have calculated the free cash flow to firm. Now you calculated the weighted average cost of capital. See, cost of capital means what? Whatever is the cost involved in establishing a company. So what will be the cost? You sell equity, so you have to give dividends. So the rate of return of the dividends given will be the cost of capital. You raise loan from the bank, you have to give rate of interest to the bank. That is again a cost of capital. You give bonds. So, and the bonds you have to pay coupon rate to the company. So if you issue corporate bonds, so you have to pay the bond rate of interest to the investors. That will also be one of the cost of capital. So the cost of capital involves payment of dividends both to equity and preference shareholders, payment of interest to debt holders. So if we consider this weighted average, see, this is the weightage given to the rate of return, that is rate of interest to the equity. Whatever dividend you are giving, that is the rate of interest, plus weightage of the debt holders into the RD, that is the rate of coupon rate or the dividend interest you are giving to the debt holder, and WP into RP is nothing but the preference share dividends you are going to give to the preference shareholders. Their weightage will be calculated here. Suppose if we say this is just a ratio, you have to understand. Weighted average cost means it is a ratio. See, if there are 1000 equity investor, 50 debt investors, and 200 preference shares, so you have to add all of them, take the weightage of each one of them, and then multiply it by the interest you are paying to the equity holders, interest you are paying to the debt holder, and interest you are paying to the preference shareholders. When you add all of this, this will become weighted average cost of capital. Understood? See, W is the weightage and R is the cost of capital. Weightage is very simple concept. It is a ratio you are determining for weightage giving to the each person in that group. What is the weightage for each person? The persons here are equity, debt and preference shareholders. Okay. Now, after you have to establish the horizon value of the firm. Now you must be wondering, what is this new word horizon value has come? See, it is the value placed on the firm at the end of the explicit forecast period. See, we have considered two periods. One is the explicit forecast period where the company is going to grow extraordinarily. So that is the explicit period. So post explicit period, the firm is going to grow at a constant rate that we have already analyzed. So we can use the constant growth model formula. We have discussed constant growth formula. So constant growth formula is what? D1 divided by R minus G. Okay, dividend after the first year divided by the rate of return minus G, that is the growth rate of the dividend. So the same formula here you are using. Here instead of dividend, what we are going to do is the free cash flow to firm you are taking. See, dividend is nothing but per share. Free cash flow to firm is for the entire company. So you don't have to get too much confused with what is free cash flow to firm and what is dividend. Dividend is for per share and free cash flow to firm is for the entire firm. Okay. So now free cash flow to firm after the H+1 period, that is we know horizon value divided by weighted average cost of capital. Instead of the rate of return which we calculated there, here we are considering there a constant rate of return is taken, R as a inflation rate. If the inflation rate is 7%, R will be taken as 7%. Or if the bank is giving you an interest of 8% for your fixed deposit, so then the rate of interest is considered as 10% or 8%, whatever it is. Here instead of that, what we are calculating is the weighted average cost of capital, which I explained, minus the growth rate of the dividend, since it is a constant growth dividend model. Now after this, we have to consider the enterprise value of the firm. See, in enterprise value we consider both equity and debt. Okay. Now the present value of the future cash flow for the explicit period, if we add to the present value of for horizon value, then you are going to get the enterprise value. So enterprise value is the present value of the future cash flow for the explicit period. That what is the formula? FCF1 divided by W, weighted average cost of capital, plus 1. The same formula, D1 divided by 1 plus R, D2 divided by 1 plus R to the whole square. Here instead of R we are saying weighted average cost of capital. That's all. I hope you understood what I am saying. Till the H horizon period. So till the horizon period means this horizon period may be 10 years, 5 years. There we said N, here we are saying H as the horizon period. Somebody uses H, somebody uses N as the horizon period. So no confusion here. So the first formula will remain the same, and after that we are going to say after the horizon period we are going to get, that is the equity share. Here VH divided by weighted average cost of capital plus 1 to the power of H. Okay. Now after this you derive the equity value. Equity value is nothing but for one share. So derive the equity value is enterprise value here calculated minus preference value, whatever is the preference value of the share, and whatever, and you have to deduct the preference value and the debt value from the enterprise value, because you are calculating equity. Equity means only to the shareholders. Preference shareholders are different, they don't have voting rights, and debt value, they are not part of equity. So whatever is the money which goes for the debt value will be deducted, whatever the money which goes for the preference value will be deducted from the enterprise value, then you get what is known as the equity value. So now after that you have to compute the value per share. It is nothing but the equity value divided by total number of shares outstanding. That will give you the equity value. What is the value of the company per share. Okay. Now, how to ascertain forecast of cash flow? Now we have come to the crux of the question. We have been using rate of return R, we have been using growth rate G, G1, G2. So you must be getting confused. Where am I getting this G1, G2? How are I going to get a value for G1? You say growth, you take G1 as the growth rate can be 4%, 5%, 3%. See, what is the basis? Now we will explain what is the basis of identifying R, that is the rate of return, identifying G, the growth rate. Okay. Now, see, first of all, we do it by analyzing the historical growth rate of a company. If the company is growing historically for the past 10 years, how it is going, you can find out through the various P&L and the balance sheets. So you can generally get an idea what is the growth rate of the company. So how are you going to know the dividend rate? The dividend rate is basically understood by proportion of earnings flowed back into the business. Okay. Suppose you get a total earnings per share as 10 rupees, but however the company gives a dividend of only 5 rupees. Where will that another 5 rupees go? See, per share earnings a company has earned 10 rupees. They are giving you only 5 rupees. Where is the other 5 rupees? That 5 rupees is plowed back and kept in reserves and surpluses, and that will be used for various activities like capex, that is expansion of the company, and various other activities. So that is based on that, what is the proportion of earning that is going to be plowed back is also one of the concepts used for calculating the cash flow, and by calculating the return on equity. So how do you calculate the return on equity? We will see. That is basically through CAPM, that is capital asset pricing model. I will explain it in a different video. It is another very important concept, capital asset pricing model. Now the growth rate of the dividends is retention rate into return on equity. So the retention rate is what? What is your retention rate? Whatever is the earnings per share flowed back into your reserves and surpluses is the retention rate into return on equity. So return on equity is ROE. There are various formula also, return on equity formula also. We can go to that and see what is return. I have explained in detail return on equity formula in my part 2 and part 3 of my equity valuation. See, company growth usually stabilize once high growth rate is over. It is it is a Michael Porter model analysis. In Michael Porter, he says that company goes through various stages. One is the introduction stage, another is the growth stage, maturity stage, and declining stage. So the high growth rate will stabilize, and after that, during maturity rate, which is going to be the longest period for any company, the growth rate will be stable. So based on this, the perpetual growth rate can be taken as the growth rate. See, this is usually equal to average long-term GDP growth rate or the inflation rate. That's what I was trying to explain to you. How are you going to take the growth rate? See, you can take the inflation rate or the GDP growth rate of the country. GDP of the country can be generally be safely taken as the growth rate for a company which has stabilized or which has entered the maturity stage as per the Michael Porter model. We can consider that the growth rate can maybe equal to the inflation rate of the economy and the GDP growth rate. Now coming to another concept of terminal value. The terminal value is nothing but cash flow of last year of high growth period. See, whenever your growth period ends, what was the cash flow for that period? You have to calculate into 1 plus normal growth rate. What will be the normal growth rate? Divided by the discount rate. Discount rate is nothing but your inflation rate minus what is the growth rate of the company. So free cash flow to firm is equal to free cash flow to firm during growth period plus this terminal value which you are going to calculate using this formula will give you the free cash flow to firm. Now how do you ascertain discount rate? See, the discount rate should reflect the risk and expectations of the investors. The discount rate used is weighted average cost of capital, which we just discussed. It considers both the debt and equity. That is going to be the discount rate. See, cost of debt, then you should ask what will be the cost of debt. Cost of debt is usually the prevailing interest rate for borrowers. I have already told you, if the bank is charging an interest of 10% for the loan taken, so that cost of debt will be 10% then. Cost of equity is found using capital asset pricing model. I will explain capital asset pricing model in a different video. You can go back to that video and see that chapter. Now the cost of equity through this CAPM is done risk-free interest rate, which I told you whatever is the risk-free. In risk-free interest rate sometimes is usually taken as the treasury bill interest rate. The treasury bill is nothing but government issue bonds, the government bonds. So the whatever is the rate of interest given by the government bond is considered as the risk-free rate, because government bonds cannot default. So today, as of today, if you take for example an RBI bond, it is giving an interest rate of 7%. So that is the risk-free interest rate. Generally, you can take 7% as the risk-free interest rate for today. See, usually the treasury bill rate. Plus, what is beta? See, beta is nothing but the measure of stock systematic. That is, systematic risk is always non-diversifiable. Non-diversifiable risk means, suppose a stock is listed in the stock exchange. Every day the stock price undergoes variation. That variation in the stock price you cannot diversify or hedge it. You cannot hedge that variation in the stock price, because there are lakhs and crores of variables involved in that. That is called as beta. So this beta you cannot you can only estimate a beta, but you cannot diversify that beta. Okay, so the beta into expected return from the market, whatever is the market return which is expected, minus risk-free interest rate is going to be your cost of equity. With this we come to the end of the part 2 of the analysis of the valuation. Now the earnings multiple approach I shall cover in the next video. So please await for the next video. Thank you.